very important part of the specification, economic growth, and it's part of macroeconomics, which is very commonly commented on or talked about in the media. This picture is from a little video called the Impossible Hamster. If you Google it, you might be able to get that video on it. Gives you a nice perspective on growth. I don't know if I agree with it or not, but it's something to think about. Okay, so it looks like a really big section of the course. These three I've put with growth because when you learn these three, it makes understanding growth a little bit easier. And learning growth makes understanding these a little bit easier as well. So they support each other. So first of all, what is meant by the circular flow of income? Circular flow of income is just the movement of money throughout your economy. So the spending of money, and people therefore when you spend money, somebody else receives it as income. So if you go to a shop, you buy something, it becomes their income. And it's the movement of money as it moves through the economy. But it can also show how changes in aggregate demand occur. And because we follow the Keynesian model as well, it's going to show how changes in real GDP occur as well. But the circular flow of income, it's not just kind of money going round and round and round. Leakages can occur. And a leakage is a withdrawal from the circular flow of income, and three things can cause leakages. So savings, so if you don't spend all your money, you save some of it, that's a leakage. If you spend money on imports, that money goes into somebody else's circular flow of income. So by somebody else's, I mean a different countries. And taxes take that money out as well, because it's money that the government have taken from you, so you can't spend the money. But you also get, on the other side of things, injections. So this is additions to the circular flow of income. And this could be investment into an economy. It could be foreign people purchasing exports, which introduces money into our economy, or the government spending money as well. So there is a diagram in your book. It's really complicated. It shows this like movement from households and firms. Yeah, I mean, technically that's circular flow of income, but I think this one's, which is at the bottom of the page, this one's a little bit more simple and straightforward to understand. So countries produce output, they produce things, goods and services, and when they sell output, they receive income, and income then gets spent on things, so expenditure, and you spend money on things, output, goods and services. So it's going round and round and round and round, and it's you know, people spending there, and it's firms producing things, and you know, it's involving everybody in the economy. But from your income, you have some leakages, savings, imports and taxes, and to your expenditure, you have injections. So we've got the investments, exports and government spending coming in there. I always think that each one of these is quite nice because they kind of match up with each other. So the opposite of an export would be an import. So we can see an export's an injection, import leakages. The opposite of government spending is taxation, so that's the outgoings of the government. This is the incomings of the government. And then the opposite of investment, savings, often get turned into investment, and that's something you might learn at the A2 level as well, the importance of savings in an economy to help it grow. And it's not just because savings just sit in, you know, a little tin under your bed, or they shouldn't. Please don't do that, because it's really not very safe. You should put your savings into a bank account, and they don't just lock it up in a safe. What they do is they actually spend it. And they spend it on investments. They're giving out loans for businesses so they can make investments. So savings and investments are actually linked, although they don't always seem that way when you first study them. Okay, so what we've done there, I'm just going to link back to the specification. Understand what is meant by the circular flow of income, show a general awareness of the concept of leakages and injections. Just skipped ahead from multiplier effects. We'll come back to that a bit later on. But let's now look at what economic growth is. So first of all, we need to know what a real GDP is. So GDP stands for gross domestic product, and it just is measuring the country's output. So what have they produced, usually over a year? Okay, what have they done over a year? Real GDP is different from nominal GDP. Nominal GDP measures GDP in current prices. Real GDP measures output in constant prices. So it adjusts it for inflation. It gets rid of the effects of inflation. And the way of measuring growth is that you're looking at how much real GDP has changed from one year to the other year, and we usually measure it as an annual percentage change so that we can compare different countries and how they're performing. Okay, so another note on what nominal GDP is. I'm just going to point out to you why you shouldn't measure growth based on changes in nominal GDP. So if GDP in 2008 was £800 billion, and in 2009 it was £880 billion, what is the percentage growth in GDP? Well, if you do change over original times by 100, you get 10%. So that, you know, if you're measuring it based on nominal GDP, you'd say, well, it's 10%. However, we need to take into account inflation. The way you can do it is this equation. You wouldn't need this for the exam, so I'm just going to zoom through this. But if you imagine that inflation was 4%, so this is the, you remember from kind of inflation presentation, this is the index number. And so it's saying inflation's 4%. And so we have to take the effect of 4% inflation out. And we just use that equation, GDP figure times base year price index, which would be 100, divided by the current year price index. So it's going to be 880 times by 100 divided by the 104, which is the current year index number, and that gives the real GDP, measuring it in constant prices, and then you can measure the difference. So 46.15 over the original, which was 800 times by 100, and it gives you a figure of 5.77%. So much lower than your 10%. So if you were measuring it on nominal GDP, if you've had inflation, meaning a rise in your prices in your economy, it means it overstates the growth. So that's why it's important to use real GDP, because nominal GDP will overstate growth, usually if you've had inflation. If you've had deflation, it would be the other way around. Okay, so let's have a look at some of those trends then. Here's some data from the BBC website. It's really good. They do an economy tracker on there, so definitely just put into Google economy tracker BBC News and you'll get this up, lots of different figures. But here we see these are measuring quarters, and this is measured a percentage, so it's growth. It's not looking at real GDP, it's looking at growth, GDP growth, or real GDP growth. And you can see wherever it's below the zero line, it means you've got negative growth. So if you have 2 consecutive quarters of negative growth, it's called a recession. So I don't know why they don't just say 6 months, but they will say 2 consecutive quarters of negative growth. Why not just say 6 months? 6 months of negative growth. But okay, I don't know. Someone, if you know why they say 2 consecutive quarters, can you just tell me why? Maybe because they measure it in quarters. I don't know. So here we go. We've got 2 consecutive quarters, more than 2 consecutive quarters. 1, 2, 3, 4, 5 consecutive quarters here. This was the recession in 2008. That lasted into 2009, and then here we have negative economic growth in the 4th quarter of 2010, but it's not a recession because they're not 2 consecutive quarters. And so lots of people talked about this double dip recession. Never actually happened though, because they weren't consecutive quarters. Back when, before you were born, I was born though, that was our last recession. There. Interesting things to look at. Oh, I wonder if I can zoom at this point. Yes, I can. Look at that. I'm just going to zoom in on this point here. Right, so we have, I don't have the axes anymore, but we can see at this point we have high growth, okay, and then the next quarter we have a smaller amount of growth. You could get a data question that says, what's happened to real GDP between this period and this period. Some students that aren't thinking clearly would say, oh, there's been GDP has fallen. It's not fallen because this graph is showing percentage change. So it's still grown, the economy's still grown, but at a slower rate than before. So it's a bit like those inflation questions where you know, you've not got deflation until it goes below the zero line. So we've not got negative growth until it goes below the zero line, like here. If it's smaller, well, with inflation, you've got the word disinflation. That's just a slower rate of inflation than the previous period. There probably is a term for slower rate of growth than the previous period, but I can't think of one off the top of my head. I think most people just say growth is slowing, or I don't know. But just watch out for kind of trick questions like that. Let's zoom out again. There we go. Okay, so we've seen how we measure it. We're just looking at percentage changes in real GDP from one year to the next year. Just want to point out at this point, growth is the change in real GDP. So real GDP is the actual output that you're producing. Growth is the change in that actual output, just as the price level is to inflation. So inflation just is measuring the change in the price level or the increase in the price level. So, you know, price level is an indicator just as real GDP is an indicator, whereas economic growth and inflation are looking at the changes. So it's important to be kind of really clear on the distinction between those two types of terms. Okay, back to the circular flow of income. Oh, just need to zoom out a bit to make it, oh, I'm zooming out too much. There we go. Oh. There we go. Okay, so if you have more leakages than you have injections, it will mean that the circular flow of income is sort of losing some value. I always try and think of this middle part as a bath, and these injections are like your tap, and this bath that you've got is a little bit rubbish because the plug doesn't work. So you have to run you've already started off with a bit of water in your bath, imagine, but you have to run your tap really fast to increase the level of the bath, because you've always got these leakages. So if your tap is running faster than the water's running out your bath, your water level is going to increase. So that's a bit like saying, well, real GDP is going to increase if your injections are larger than your leakages. But if your leakages are larger than your injections, as in if your plug hole, the water's running out of that faster than it's being put into the bath, your real GDP is going to fall in the end. So there are actually, when we're looking at measurements, there's actually 3 ways of measuring real GDP. Now I've defined real GDP as gross domestic product, so product being what are you producing in the year, so the output that you're producing. But as we can see from the circular flow of income, it should be equal to the income. So what you produce should equal what you've earned for what you've produced, should equal what has been spent in the economy for what you've produced. Okay, so theoretically speaking, you could measure any one of these in the economy, and it'd have to be earned income, but you can measure any one of these and they should all come out at the same value. Reality, they're not going to, because you're going to get some accounting mistakes, and we live in a big economy, you know, it's hard to capture everything. But what are the problems with measurement? So these are just the technical problems with measurement. So if you're measuring output and you're using that to measure GDP, you need to be careful to avoid double counting. So the example that I'd give is, imagine that you're looking you know, a burger, and we all know that burgers, or beef burgers at least, come from cattle. The meat comes from cows. So imagine a farmer sells a cow, and they sell it onto you know, kind of a butcher, and they get a certain amount of money for it. Okay, now the butcher's bought the cow, then they process it, that's a polite word for it, and turn the meat into burgers, and then they sell the burgers, and then a restaurant buys the burgers, and they turn them into cooked burgers, and they sell them to the consumer. Okay, if you were looking at the output that they've produced, you can't just look at the price that they sold the products for. You've got to look at the value that they added, and the value that they added is the price minus the cost, basically, of those inputs. So that you're just avoiding, because if you just measured the price of the outputs, you'd be double counting for some of those items. So that's a problem with the output method. The income method, if you just measure the income, I've kind of alluded to this in the last slide, but you only want to count income that's been earned and no transfer payment. So benefits would be a transfer payment. It's not money that's earned. An expenditure method, you need to include any expenditure on exports and exclude any spending or expenditure on imports. So you just need to make sure you capture those things. Okay. However, a more common question that you might face is problems with interpreting GDP figures. So you might have some figures presented to you, and they say that you've had growth in a country, and you have to interpret whether is that data accurate? Is it as it seems? So first thing is you need to obviously check that you're using real GDP and not nominal GDP, because nominal GDP will tend to overstate economic growth. You want to use real GDP per capita, so the Latin for per person, because of course a country like the USA are going to have a much larger real GDP than, say, a small country or a collection of countries like the UAE, because America's a very big country. They can produce a lot of output, but if you divide it by the number of people, what you're getting is a figure that you can compare. So you can compare large countries to smaller countries, and that's why you'd want to look at GDP per capita. Also, you might want to just have a little bit of, take the figures with a pinch of salt, say, because there might be a very large informal economy. Now, an informal economy is an economy where you have business activities going on, but people aren't declaring that they're doing things. It's like cash in hand payments, and they're probably doing it to avoid tax. And Greece actually has a really large informal economy, and I know this because I used to work in Greece, and yeah, there's quite a bit of it that goes on. Some estimates say it's about 30%, and I would agree with that. So yes, not particularly good practice. But therefore, when you look at Greece's growth figures in terms of output they produce year by year, it'll understate the growth because a lot of economic output is unrecorded, or it might even overstate it. Just because it's you're not recording kind of properly, accurately year to year. And also, another point is regrettables. So spending money on war activities, so funding of your army would be government spending. And so that could cause an injection into your cycle flow of income. So you might get loads and loads of growth during war years, but it's just fueled by things that don't actually improve people's standards of living or improve people's lives. People spending money on double glazing increases real GDP. But if you've had to spend money on double glazing because of noise pollution, you're just restoring your life back to what it was before the noise pollution. Say there's a new, train line opened up near to you, for example. So you're not really improving your life with the double glazing, are you? You're just restoring it back to what it was. So I wouldn't say that, we're trying to use GDP basically, an output or growth as a proxy for saying, are people's lives getting better? So here, these ones are really looking at the problems of using GDP as a proxy for standard of living. And also, economic growth may be very unequal, so it might not be distributed equal. It might be that the benefits of economic growth, as in who's getting richer, is just the rich people already, and actually some of the poorer people are getting a lot poorer. So you get this unequal distribution of income. I've got a nice cartoon here. Economic growth indicators are up, led by car repairs, divorce costs, open heart surgeries, and toxic waste cleanups. So, just saying that it's not just because you have economic growth doesn't necessarily mean it's a good thing. Okay, so we've done all of these at this point. So we've done a really, really large number. So what are the objectives for economic growth? The government objective, they want as high growth as possible, and they want it to be positive. Some economies set targets. I don't think we really set targets. To be honest, some politicians mention targets sometimes, but we just want positive growth. Okay, so what causes economic growth? Well, in the short run, and we use the Keynesian model at my college, an economy with spare capacity, so this would represent the vertical part, represents the economy where we don't have spare capacity. An economy with spare capacity can experience economic growth through an increase in aggregate demand. So we've got Y1, Y represents income, but real GDP is either income or output or expenditure, so that's why we use Y on this axis, and we can see it increasing. So we've got economic growth, but in the long run it has to be an increase in the productive capacity of the economy. So it's got to be increases in the quantity and quality of resources or factors of production, so land, labour, capital and enterprise increasing in quality and quantity, and there we have aggregate supply moving outwards, and we can see this increase in income. If you look at which one you'd rather have, well, in this economy we're causing a bit of demand pull inflation, whereas this economy price level's actually fallen. So this one's more sustainable, more long term. So if we look, usually, I'm going to flick forward to benefits. Usually we think that economic growth is a really good thing and we want to encourage it because it actually, to produce more output, or when there's more demand for output, we need more workers because workers are derived demand, or labour is derived demand, so it increases employment, and there are lots of benefits from having higher levels of employment and lower levels of unemployment, as we've seen in the other presentation. It should, if incomes are increasing and people are more, because there's more employment, so more people are getting paid, it should mean that people are able to afford more goods and services, so it should increase your material living standards, and also enables poverty to be reduced without the need for higher taxes. So because people are earning more and spending more, it means, so they're buying more products, they're naturally spending or contributing more to VAT because they're purchasing more products. It's not that the VAT rate has gone up, and if you earn more, you might not even make it into a higher tax boundary or bracket. It's just that you're earning more, you're paying 20% tax or 40% tax on that additional that you're earning. The government can use that money on government spending and try and reduce poverty. However, there are some costs of economic growth, so it might be through methods that increase pollution or use up natural resources, so it's not sustainable. It may be very unequal, so it's only a certain part of society that benefit. It may occur without any increase in employment. You may be able to produce more because you've got more automation or increase in productivity. And it might actually decrease your living standards because it might mean that it's been achieved through working longer hours. And so therefore it's not really a very good proxy for kind of happiness. Okay, you've got more money, but are you any happier? So that's something to think about. Why do we focus on achieving economic growth? Why is it so important? Something to think about, not necessarily something that's going to be, well, won't be on your exam, but definitely something to think about. Okay, so we should have covered all of the specification objectives. The only one we've not covered from that list is show a general awareness of the multiplier effect. That's going to come up in one of the ADAS presentations.